Deciphering the economic symphony, the role of GDP and unemployment in investment analysis. In the intricate realm of investment analysis, economic indicators emerge as guiding stars, illuminating the path for investors navigating the dynamic landscape of financial markets. Among these, gross domestic product (GDP) and unemployment stand as stalwart sentinels, offering insights into the health of economies and influencing investment decisions in profound ways. To unravel the role of these economic indicators in investment analysis, one must delve into their intricacies and understand how they shape the ever-evolving narrative of market dynamics. GDP, the economic pulse. Gross domestic product, often referred to as the heartbeat of an economy, encapsulates the total value of all goods and services produced within a country's borders. Its significance in investment analysis lies in its ability to gauge the overall health and growth trajectory of an economy. A rising GDP indicates economic expansion, fostering investor confidence and prompting a positive outlook on the markets. Consider a scenario where a country experiences a robust GDP growth of 4% in a given quarter. This surge may be indicative of increased consumer spending, business investments, and international trade, all of which bode well for corporate profits. Investors, armed with the knowledge of a growing economy, may be more inclined to allocate funds to equities, anticipating higher returns as companies thrive amid favorable economic conditions. Conversely, a contracting GDP can signal economic challenges such as recessionary pressures. During periods of economic contraction, investors often adopt defensive strategies, reducing exposure to riskier assets and favoring safer havens like government bonds. The insight provided by GDP figures enables investors to adjust their portfolios strategically, aligning with the prevailing economic winds. Unemployment, a crucible of economic health. The unemployment rate, a key economic indicator, serves as a litmus test for the labor market's health and, by extension, the overall economic well-being. When unemployment rates are low, it signifies a tight labor market, often leading to increased consumer spending and a potential uptick in inflation. Investors interpret low unemployment as a positive signal for corporate earnings, anticipating higher demand for goods and services. For instance, if a country reports an unemployment rate below the natural rate of unemployment, signaling full employment, investors may expect wage growth and increased consumer confidence. This, in turn, could prompt a shift towards consumer-oriented stocks as companies catering to discretionary spending stand to benefit from an employed and confident consumer base. Conversely, a spike in unemployment rates can trigger concerns about economic contraction and diminished consumer purchasing power. During periods of rising unemployment, investors may favor defensive stocks, such as those in healthcare or utilities, which tend to be less sensitive to economic downturns. The unemployment rate thus serves as a vital compass for investors navigating the labor market's complexities and anticipating broader economic trends. The symbiosis of GDP and unemployment in investment analysis. GDP and unemployment are not isolated indicators, rather, they engage in a symbiotic dance, each influencing and shaping the other. A thriving economy, as reflected in a robust GDP, often leads to job creation and a decline in unemployment. Conversely, economic downturns, reflected in a contracting GDP, can contribute to rising unemployment as businesses cut costs and adjust to challenging conditions. Consider the aftermath of the 2008 financial crisis. As GDP contracted, unemployment rates soared across many economies. Investors, grappling with the dual challenges of economic recession and rising unemployment, sought refuge in safer assets and adopted defensive investment strategies. Understanding this interplay between GDP and unemployment is essential for investors to anticipate market movements and position their portfolios strategically. Forward-looking insights. The significance of GDP and unemployment in investment analysis extends beyond their historical snapshots. Investors often scrutinize these indicators for forward-looking insights, seeking clues about the future direction of economies and markets. For instance, a divergence between GDP growth and unemployment trends may indicate potential shifts in market dynamics. If a country experiences strong GDP growth alongside a rising unemployment rate, it could suggest productivity gains or technological advancements that are transforming industries. Investors, armed with this knowledge, may pivot towards sectors poised to benefit from such transformations, even as the broader labor market undergoes adjustments. Policy implications and central bank moves. GDP and unemployment figures play a pivotal role in shaping the policies of central banks and governments. Central banks, tasked with maintaining price stability and fostering economic growth, often adjust interest rates in response to changes in these economic indicators. Investors keenly monitor central bank actions, as shifts in monetary policy can have far-reaching implications for financial markets. Consider a scenario where a country faces slowing GDP growth and rising unemployment. In response, the central bank may opt for monetary stimulus, lowering interest rates to encourage borrowing, spending, and investment. Investors, anticipating such policy moves, may adjust their portfolios accordingly, favoring assets that typically benefit from lower interest rates, such as equities and real estate. Conclusion. In the intricate symphony of investment analysis, GDP and unemployment take center stage, harmonizing to create a melody of economic insights. As investors navigate the ever-shifting currents of financial markets, these indicators serve as beacons, offering valuable clues about the health and direction of economies. Armed with an understanding of the nuanced interplay between GDP and unemployment, investors can make informed decisions, adjusting their portfolios to the rhythm of economic dynamics, and positioning themselves to weather the complexities of the investment landscape.